This is an Ask Slim special presentation. Tools for Techs. News versus chart structure. That's Brexit versus SPX. All right, well, we have all been hearing a lot of news about the coming Brexit vote. That is Great Britain potentially leaving the European Union. And of course, they're in the European Union, but they elected to keep their own currency. And now there's a lot of dispute, and Prime Minister Cameron, because there was so much dispute about whether or not there was a benefit for them to be in the EU, decided to have a referendum on it, put it to a vote, rather than it be something that he makes a decision on. And that has really brought up a firestorm in Great Britain. So in Future Speak on Wednesday, I mentioned, that I'm watching the stock market structure, and said that it's still positive. It essentially is the similar structure, the same structure that it's been in since it gave us that 300-point rally in the S&P 500. Well, mostly it is, but we're going to look at that just in a little bit. I'm watching for red flags, and right now I would say there's not really a red flag that structure is breaking down. Well, maybe. I'll show you that too. Many have asked me as they send me emails to explain the Brexit, really how it affects the markets, what it is, and what we can expect based on the different results. A lot of what I believe is that the markets are pricing in the fact that whatever the greatest risk is, because we're getting these giant moves in the gold market and bond market and into the dollar, and that is all, flight to safety type action. So just quickly to explain what the two sides of this are, and then we'll look at at a chart and look at the news of the Brexit potential versus the structure in the market, because I really want to talk about what my mindset is when I'm looking at these charts and seeing how the markets are acting. And a lot of markets getting sold pretty hard in this last week or more, based on fears. So there are two sides to this. They're the ones that want to stay and the ones that want to leave, or some call it remain and exit, hence Brexit. So let's just talk about what the people on the stay side are saying, what their argument is. They say that the fear or the risks are that if they leave, so the reason they want to stay is that there are trade agreements within the EU that benefit Great Britain, and they say that then trade will break down. They won't be benefiting from those laws that allow that trade within the European Union. They say because of that, the economy will slow and that jobs will be lost, and especially the unions are in favor of staying for that reason. And if that were to happen, there would be less government revenues, and of course a lot less money to spend. There's a lot of talk about defense spending falling pretty significantly if they do leave based on the lower revenues. And they talk about the fact that there'll be a pretty big struggle to survive on their own, and that it's better to live within the European Union laws. And that those laws they can live with, even though one of the big issues there, and maybe really the one that's weighing the most on the whether or not they stay or leave, is immigration. The immigration problem, the people that want to stay say immigration will get worse. And that essentially means that the protection of the borders of the whole continent will then be gone. And then the only immigration protection is essentially at the border of the UK. So there's a lot of filters supposedly that would be lost for their immigration problem. And another big one is that financial companies, they're all balking. You hear a lot from Deutsche Bank because they say that if they do vote to leave, then the financial companies, a lot of them will leave and then move to Brussels. And of course, the big fact that London's a big financial hub, that might be lost. So a lot of the financial business, they're afraid, would be lost. So that's basically the argument for the people that want to stay. Now, the people that want to leave, basically what the rewards are leaving are, or what they'd be rid of, are that they'd be free of Brussels, and Brussels essentially puts in a ton of financial regulations, and there's lots of talk there by the financial companies about those regulations and how commissions are handled and how things can be spent. The people that are looking at immigration say they would be free to restore the borders of the UK. In other words, all of this open border crossing that's going on is allowing a lot of immigration to come in, especially from Syria and problem countries into the UK, and they want to stop that. So they would then be able to restore their borders and not have this free crossing going on. I don't want to really talk much about that, but we know the difficulties that's causing over there. They talk about that they will be free of supporting the weaker countries. Now, UK is the fifth largest economy in the world, and they put in some 10% of all the money into the EU and the 19-country union, soon to be 25 or 26, right? With 7 new countries potentially coming in. So that means that they've been supporting Greece and Italy and Spain and Portugal, these problem countries, and they want to be free of that. And free of this downward pull of the slowing European economy, which a lot of that is, the ECB, which is in the same trap as the rest of the world, and these 0% interest rates. And I think the UK wants to be much more normal. And then the last one is about trade. They're not worried about the trade deals so much as far as the trading within the European Union. They think that would be reestablished, or new rules set that they'd be able to trade pretty freely. There's a lot of countries that are dependent upon the UK. But the big thing is that then they'd be able to make deals with India and China, which they have restrictions on right now. So the people that want to leave, they've got some pretty strong arguments there. Of course, the bookmakers are what people are looking at, and we've seen the stock market today turn around from somewhat of an important area, moving from sharply down now as I record this to the plus side. And the news is likely to start coming out a bit more favorable, and that is because they're looking at the bookmakers, and the bookmakers are saying the odds favor staying. And a lot of that is about the independents that aren't really stepping up yet, and usually they pretty much want to stay status quo. So they're saying that overall the bookmakers, which tend to be more right, are saying that they're likely to stay, and all of this fears has just been fear-mongering, and that the stock market and gold markets and all these markets that have been moving at some extreme way are wrong. The investors are wrong in what they're doing, buying all the protection, implied volatility soaring. So personally, I think that it's an overreaction, and I think a lot of it is being priced in. And even if they vote to leave, we might only see a day or two of reaction, and then the market's rebounding. And one other important aspect is that it's going to take them some years to implement this. So it's not like they vote to leave and then all of a sudden everything's changed. I mean, that's not the case. There's going to be then a lot of discussion of, okay, they voted to leave. Now, how exactly do they do that? So I think there's been a lot of overreaction in the markets. So that's the news. So let's talk about stock market structure, right? And what I look at in the charts to see, what it would mean if it was a negative structure, what's still a positive structure. Basically, where are we right now as we look at the chart of the S&P 500, a daily chart, one that is different basically from one I've showed you recently, and the same. Here is that chart we're going to look at in here. And we're going to look at essentially comparing two periods in here. The periods that we're going to be comparing are right in here, which is 2015 to this stock market correction here, and then the big rally over here in 2016 and what's going on right now. So let's first look at the rise right over here, which came from this after this decline in the summer of 2015 through this rally into the winter of 2015. So note in here, and I'll make some comparisons, that this was a bullish rising structure. What makes it so? Well, in here you can see I have the cycles laid out, and interestingly they have held pretty steady all the way through, all the way over here, with one slight variation like right over here. So what this meant is that you can see the low that was made here and then the test of the bottom, and basically this was a bullish structure or a base, and then you had another positive cycle right here and another positive cycle right here. So you had three positive cycles basically in a row on a bullish structure. So let's look at how the structure began to break down. And this is during the period here of the fear of interest rate increases and a lot of discussion about that. What happened was that as we got into this cycle correction right over here, the market gave up 95% or more of this low. In other words, it went up and came almost 100% down right over here. That's a warning when that happens, especially when you get, a close down right over there, right near it, that the next rally is likely not to make a high. It actually got a little further than I expected it to, but you can see it failed to make a high. And then when it sold off in this cycle decline, it got below this low. That is a warning that a major top had been put in place. You would expect the next rally to not get very high, and you could see that happened in here. And then when it broke below this cycle low right over here, you had a cycle breakdown and a continuation of the big decline. So this whole period that I'm talking about in here was a breakdown. In other words, it showed weakness right in this cycle, it got lower and showed the breakdown in here, and then early it broke down here and gave you a big decline. A lot of negative occurrences in here as the top came in 2015, early 2016. You can see that. And we were very bearish. We expected a big decline in here, and that worked. So let's compare that to the market that we're in now. And the market we're in now is the fear of Brexit right over here. Bonds, gold, the dollar, lots of money moving into there and out of stocks. You can see the financials are really getting hammered in here. The transportation stocks really getting hammered. And so let's compare that to what's been going on right now. Well, you can see the rising bullish structure here and the rising bullish structure here. In fact, maybe even a little more positive. And you have the three cycles, 1, 2, 3, all in positive. This one here, this one here, this one here, and whoops, this one here took out this low. And that was a fake to us. You can see it left that hammer bottom. And to us, it was giving a warning. We did not, when we saw that, we were cautious that we would not get a rally to the new high. We did get a rally to the new high. Right over here as it moved up to 2120 on the S&P 500. However, it's creating this broadening pattern. This is a topping pattern right over here. Now, when you get broadening patterns like this and you fall like halfway into it here, odds are pretty good that you're going to get back up towards this area and extend out the broadening pattern, maybe even get a little bit higher. Now, that has us thinking that we're going to test the all-time high. We've been saying that as the structure has remained positive. Now, what do we mean structure remained positive? Well, you did take out this high right over here, right? That's positive. And what happened was that you fell, and now when you got down close to the 78.6%, you had this big upside reversal. Let's only look now at this period right in here, and you'll be able to see clearly what we're looking at here as we're analyzing it. So here is this cycle right in here that we're looking at. And this one right over here, you can see gets down close to the 78.6%, has the big upside reversal today. So we believe that we're still in the broadening pattern. We believe that the structure of this, because it made the new high, is still a positive structure. We also believe that the broadening pattern is a warning. and that we could easily get back up to above that high as a final move, which is what we've been expecting. We think that a lot of the stock patterns are suggestive of this, that this period in here, which is several weeks long and maybe after the Brexit vote, will get you up back to the top of the broadening pattern. So we held this important area and we rallied today. So now what about the resistance areas and what will the messages be? If we can get up through these resistance numbers, we know that we're right about the test. So we're going to be watching those numbers, the test of the all-time high at 2134. If it turns out that we get this rally as we're expecting, and remember we talked about the 9-day patterns in here, which are right in here. You can see those right here. That's these guys right here, very clear. This one right in here, and this a perfect 9 today. You can see that. There's all those small patterns right in there. If I were to use the cycle brackets, I could show you that as they line up right about like this, and this low that comes in right basically where we are right now. And that then says that we've moved into this new rally period right in here. If it turns out that we get this rally and it lasts some number of days, let's say gets up to this level here, and then turns down and breaks that low, well, then you will know the kind of trouble the market's in. If it gets up through these areas, well, then you know that we're right about the upside momentum still being in place, but the broadening top really being that of a major concern. So that's what we're looking at in market structure. Market structure is telling us that this structure that we're in, though a warning of topping, is nowhere near as negative as this structure was in here with the declining tops and declining lows and the eventual breakdown. So a lot of people are comparing this period and this period here, and right now what we're seeing is a more positive structure in the stock market and what we would consider to be a likelihood that the market has another surge coming back up to the top of that broadening top, and likely to be that 2134 to 2140 area of resistance. So right now the S&P 500 at 2076. So where we see the potential for some 3 or 4% on the upside, and here it's not an overwhelmingly bullish statement that we're making. And on the other hand, there's still some room to rally, and the structure of the market is still okay. We think that the news out of Great Britain is going to tend to be more bullish, and that it's going to be supportive of a rebound in here and a pullback in these other markets that have been really going crazy, gold market and bond market especially. And that to us, if we get a move, that looks a little better for the stock market and those give ground, comes the vote. If they vote to leave, well, you know that for a couple days we're going to see the stocks get hit very hard, and we're going to see gold move up sharply, bonds move up sharply, probably the yen even move up sharply, but I think that would also be temporary because they'll be looking at a long-term adoption of this new structure in the EU, and also once we get some rebound going on, if that were to happen, then they're going to be looking at what is the potential that Great Britain leaving starts a domino effect and really weakens the whole EU, and that's a whole different story and a whole different picture. So right now we're just looking at the short-term, intermediate term, and the pattern in the S&P 500 looks like it's got another shot at the high, and at the same time we think there's a bigger top that's in the process of forming. That is today's Tools for Techs. I think it was an interesting one. Love to hear your comments, and I will see you in the next segment.